Dear students, welcome to lecture 2 of week 3. In week 3, we are discussing different issues related to legal and regulatory framework of export and import. Today, in lecture 2, we are going to talk about FEMA 1991, its objectives and key provisions. FEMA stands for Foreign Exchange Management Act, which was enacted in 1999. Let us begin the journey. At the outset, let us have an overview of the contents of today's lecture. We will be introducing the topic as well as discussing a bit about evolution of FEMA. After that, we will try to highlight the objectives and scope of Foreign Exchange Management Act, followed by key definitions and features. After that, we will talk about the differences in the transactions of current and capital account, followed by role of RBI and central government. After that, we'll try to understand the importance of authorized person and dealers, authorized dealer banks in terms of this act. Management and capital regulations will be the next issue which we will be discussing, followed by foreign direct investment and foreign investment provisions. We will be also looking towards penalties and enforcement, followed by liberalization and recent developments. After that, we will try to focus on challenges and best practices before we conclude the lecture. The Foreign Exchange Management Act is a 1991 key legislation governing foreign exchange transactions in India. We are aware that any country which is going into the international market has to trade with other countries with respect to different foreign currencies. Their trading relates to exchange of one currency into another currency. Thus, foreign exchange is a regular economic phenomena for countries that are participating with other countries in terms of international trade. What should be the rules or regulations related to foreign exchange are framed from time to time by the governments for their country specific policies. Governments do not have control over the foreign exchange rate, but they can have control over the policies, rules, and regulations related to foreign exchange. These are termed as foreign exchange regulations in different countries and they are prevalently used in international trade. Thus, India's foreign exchange regulations comes in the form of Foreign Exchange Management Act of 1991. This Foreign Exchange Management Act of 1991 replaced the old restrictive act related to foreign exchange which was known as Foreign Exchange Regulation Act of 1973. The old act was very rigid and also it had become obsolete in terms of the contemporary changes in foreign exchange markets. Foreign Exchange Management Act of 1991 is more liberal, facilitative framework in comparison to the old FERA of 1973. Foreign Exchange Management Act aims to manage foreign exchange in a way that promotes external trade, payments, and orderly development of the forex market. For a Foreign Exchange Management Act of 1991 is essential for regulating cross-border capital flows, foreign direct investment, remittances, and trade transactions. Let us discuss the evolution, how India reached to FEMA, replacing the old FEMA that is Foreign Exchange Regulation Act. The Foreign Exchange Regulation Act was enacted in 1973. It was enacted in a very controlled economy. Controlled economy is also known as, in economic terms, the planned economy. What happens in controlled economy? In controlled economy, the control belongs to government and there are strict government regulation and policies that manage all the things from the purview of the governments. Also, the Foreign Exchange Regulation Act was enacted mainly for strict regulation and conservation for foreign exchange. The Foreign Exchange Regulation Act 1973 was criminal in nature. It means punishment was treated as criminal punishments and violation were treated as offenses. This was a major drawback with the FERA because of which it was a very rigid and very exploitative act. In 1999, this FERA was replaced by Foreign Exchange Management Act. It was bought in the post liberalization to facilitate trade. With India being liberalized in the mid of 1991 through liberalization, globalization, and privatization policies, the whole nature of Indian economy started to change. Multinational corporation from rest of the world started coming in the Indian economy as well as the cross border restrictions were removed. This particular movement facilitated more trade in the economy and more opportunities started to emerge. That was the time when Foreign Exchange Management Act's need was felt by the government and other regulatory bodies in order to make foreign transaction easier because new MNCs were coming and as well as to attract more new MNCs, it was very important to make the foreign transactions easier. However, alignment with World Trade Organization was also one of the objectives. Thus, with all these objectives together, this Foreign Exchange Management Act was enacted in 1999. The speciality of this act was that this act shifted focus from control to management and facilitation. While in FERA the objective was to control, the objective in FEMA was management and facilitation. The whole scenario changed because of the focus and this Foreign Exchange Management Act, instead of curtailing the foreign transaction, it started accentuating and improving and facilitating the foreign exchange transfers. The new approach, that is the Foreign Exchange Management Act's application, supported India's integration into the global economy. Let us now discuss the objectives and scope of Foreign Exchange Management Act. The first scope of Foreign Exchange Management Act is to facilitate external trade and payments. External trades and payments are to be done in forex exchange. And because it involves foreign currencies, it is very important to trying to monitor and facilitate it. FEMA fulfills this objective. FEMA also promotes orderly development of the foreign exchange market. The second objective of Foreign Exchange Management Act is to maintain foreign exchange stability and ensure balance of payment sustainability. If we recall before 1991, it means in pre 1991 period, India faced severe balance of payment crisis. The crisis was such that India was left with very less forex reserve to buy oil from the international market. This kind of balance of payment crisis can be mitigated or can be removed if foreign exchange stability is maintained into the economy. And this foreign exchange stability can only be maintained if the objective of Foreign Exchange Act is not to control but to manage and facilitate. This feature of manage and facilitation was introduced in FEMA, that is Foreign Exchange Management Act. The third objective of Foreign Exchange Management Act is to regulate foreign capital flows, investments and cross-border transactions. We all know that India is a developing country, and like other developing countries, India also need foreign investment. The domestic investment which is available in India is not sufficient to make India an economic might. Thus, the foreign investment is required. The foreign investment comes in forex exchange. Thus, the objective of FEMA was to regulate the foreign capital flows as well as to promote foreign investment into the economy. The fourth objective of Foreign Exchange Management Act is to simplify procedures for foreign exchange dealings and improve ease of doing business. Ease of doing business. One of the important things which relates to ease of doing business is that if a country's ease of doing business is good, that doing business is very easy, it means that financial transactions can also be easily done, which means that the foreign exchange rules and regulations are very simple and they are not complex. Thus, Foreign Exchange Management Act wants to achieve simplification in foreign exchange transactions as well as keep a stability in the foreign exchange reserves. The final objective of Foreign Exchange Management Act is that the act extends to the whole of India and applies to all citizens and companies dealing with foreign exchange abroad. Dear students, let us now try to understand and appreciate the key definitions that are mentioned under Foreign Exchange Management Act. The first definition is foreign exchange. According to FEMA, foreign exchange includes foreign currency, drafts, letters of credit, deposits, and instruments payable in country's currency and instruments payable in foreign currency. The second key definition is authorized person. In the FEMA Act, any individual, bank, or institution authorized by Reserve Bank of India to deal in foreign exchange is considered to be authorized person. The third key definition is current account transaction. Under FERA, transaction that relates to trade in goods or services, interest payments, and remittances are included in current account transaction. The next definition is capital account transaction. In terms of FEMA, transactions affecting assets or liabilities outside India, for example, foreign direct investment, are considered under capital account transaction. The next key definition is person resident in India. Person resident in India is defined based on period of stay and intent of residence under the Foreign Exchange Management Act 1999. So these are the key definitions that are repeatedly used in Foreign Exchange Management Act to clarify and explain different regulations and provisions of the Act. Let us now move on to features and principles of Foreign Exchange Management Act. Foreign Exchange Management Act is a civil law instead of a criminal law. If you can recall, The FERA, which was earlier valid, that is FERA 1973, was the act which was considered to be the criminal act because there the violations were considered as offenses. Thus, FEMA is a civil law where violations are treated as civil offenses and not criminal offenses. The second feature of Foreign Exchange Management Act is that it focuses on management and regulation rather than prohibition. It means that the deliberation and focus of FEMA is on management and regulation as well as facilitation instead of prohibition. The third feature of Foreign Exchange Management Act is that it allows free current account transaction unless specified unless specifically restricted. It means all current account transaction can be converted back to the foreign currency and there is no requirement as such of delaying the or taking necessary permissions from the government. Only in certain specific cases, current account conversion requires additional clearance from Ministry of External Affairs or from Reserve Bank of India or any other body that is being mentioned. Another feature of Foreign Exchange Management Act is capital account transactions. The capital account transactions that deals with the long term capital flows are regulated and they require approval. In other words, this is known as capital account convertibility. The capital account convertibility is not fully accessible right now in India. It means capital account convertibility is not 100%, which means that immediate conversion of the invested amount in the other country's currency is not proper, is not possible as it is being regulated and it requires approval under the Foreign Exchange Management Act. The next important feature of Foreign Exchange Management Act is that Reserve Bank of India plays a central role in implementation, supervision and control. Foreign Exchange Management Act also encourages transparency, compliance and investor confidence. Let us now try to identify the difference between current account transactions and capital account transactions. Current account transactions are day to day foreign exchange transactions such as import export payments, interest, travel, education, and remittances. Current account transactions are governed by Section 5, which says that they are free unless restricted by government. The second type of transactions are capital account transactions. Capital account transactions are those foreign transactions which alters assets and liabilities of the country. For example, foreign direct investments, overseas investments, ECBs, etc. These transactions are governed by Section 6, which is regulated by Reserve Bank of India. This classification is very important for compliance and regulatory approvals. Let us now try to focus on the role and powers of Reserve Bank of India. Reserve Bank of India is the primary regulatory authority under Foreign Exchange Management Act. It directly deals with Foreign Exchange Management Act and closely monitors whether the act has been applied in principle and spirit in the country or not. Any violation of Foreign Exchange Management Act is considered to be an offense and no doubt Reserve Bank of India keeps a very vigilant eye on such practices. The different responsibilities of Reserve Bank of India with respect to Foreign Exchange Management Act. The first is RBI grant authorization to banks and financial institutions. Second, Reserve Bank of India frame regulations for current and capital account transactions. Number third, Reserve Bank of India monitor forex reserves, balance of payment and external liabilities. And finally, Reserve Bank of India issues guidelines for foreign direct investment, outward direct investment and foreign borrowings. With this, we can conclude that Reserve Bank of India's powers ensure stability, control, and transparency in foreign exchange dealings with respect to Foreign Exchange Management Act. Let us try to appreciate the role of central government in terms of Foreign Exchange Management Act, that is in terms of application and monitoring. Central government has powers to number 1 impose restrictions on foreign transactions in national interest. Number 2, central government has power to regulate trade in sensitive goods that may be risky for the country or such services and technology. Number 3, central government can notify prohibited or restricted transactions, which means they can from time to time indicate which particular transactions are allowed and which are not allowed. Number 4, Reserve Bank of India works closely with the central government, and the fourth important point is that central government coordinate with international agencies for anti-money laundering and foreign investment monitoring. Thus, central government works closely with the Reserve Bank of India to formulate policy and manage the foreign exchange environment. Dear students, let us now try to briefly understand the importance and the concept of authorized persons and authorized dealer banks. Authorized dealers are banks and financial institutions that are approved by Reserve Bank of India to deal in forex, that is forex exchange. These have technical know-how and expertise in dealing with forex exchange, and they can provide speculative benefit to their clients. The categories include AD, that is authorized dealer category 1, which are banks. Second level category is exchange houses. Third level category is selected non-banking financial corporations. NBFCs are at the lowest level, but they are very interesting because NBFCs, non-banking financial corporations, non-banking financial corporations, they are such institutions which are regulated both by Reserve Bank of India, but they are registered under Companies Act 2013. Thus, they are non-financial companies, and they are non-banking companies which are formed under Companies Act but are regulated by Reserve Bank of India. The key responsibilities of authorized person and authorized dealer banks is to facilitate trade and remittances. Number 2, to ensure KYC, that is know your customer, and AML compliance. Third, report transactions to Reserve Bank of India. Authorized dealer banks act as a key intermediary between businesses and regulators. Let us now try to understand the foreign exchange management regulations. Reserve Bank of India issues regulations under Foreign Exchange Management Act which covers several important issues. Number one, it covers import and export of goods and services. Number two, it includes remittances, travel, education, and medical expenses. Number three, it is about acquisition of property abroad or by non residents in India. Another one is opening foreign currency accounts. These regulations provide detailed operational guidelines for forex transactions. Let us move to the another topic, capital account regulations and foreign direct investment. Capital transactions include foreign direct investment, outward direct investment, external commercial borrowings, and foreign portfolio investment. Foreign direct regulations define entry routes, that is, automatic or government approvals, sectoral caps, that is, in which sector what will be the limit of FDI. For example, in India, the limit of FDI in insurance sector is 49%. Then, and reporting requirements. Outward direct investment or overseas investment rules govern overseas investment by Indian entities. ECB policies regulate external borrowings by corporates. All these frameworks related to capital account regulations and foreign direct investments ensure capital inflows contribute to growth without causing macroeconomic instability. Let us now talk about contravention, penalties, and education. Contravention of Foreign Exchange Management Act provisions may result in monetary penalty up to thrice the sum involved and confiscation of property or assets involved in violation. Thus, the exporters should be very careful about these following of the Foreign Exchange Management Act. Then we have the educating authorities which are appointed by central government to inquire into violations. It is very important that violation should be properly inquired because if they are not correct then there can be huge setback to the exporter community. The next is compounding mechanism allows voluntary admission and payment of penalty without litigation. Under contravention, penalties and adjudication, appeals can be made to the Special Director of Appeals or Appellate Tribunal. Dear students, let us talk about foreign exchange management and liberalization. FEMA has been a cornerstone of India's post 1991 economic reforms. It has facilitated large foreign direct inflows and global integration. FEMA has liberal remittance schemes which have enabled Indian companies to expand globally. The Foreign Exchange Management Act has also improved investor confidence and boosted India's ranking in ease of doing business. Foreign Exchange Management Act supports India's aspiration to become a $5 trillion economy. Let us also try to understand the recent amendments and policy developments. The recent amendments in the FEMA Act include simplification of FDI, that is foreign direct investment norms, and automatic routes in key sectors. For example, defense, re- retail, and financial technology, fintech. Also, the liberalized remittance scheme allows individual to remit up to 25 up to United States dollar 2,50,000 annually, which is a new policy development. Similarly, digital payment and fintech, that is financial technology related cross border transactions, regulated under updated guidance, are benefiting the digital economy of the country. The recent amendments have also strengthened AML and CFT compliance under the global FATF norms. The continuous evolution ensures that Foreign Exchange Management Act remains relevant in a dynamic global environment. Let us talk about FEMA and liberalization. FEMA has been a cornerstone of India's post 1991 economic reforms. FEMA has facilitated large foreign direct investment inflows and global integration. There is also liberal remittance schemes which have enabled Indian companies to expand globally, and Foreign Exchange Management Act has also improved investor confidence and boosted India's ranking in ease of doing business. Foreign Exchange Management Act supports India's aspiration to become a $5 trillion economy. Let us now move to best practices of businesses. In terms of FEMA, there is a need to stay updated with Reserve Bank of India circulars, notifications, and FEMA regulations. There is a need to consult authorized dealers and legal advisors for complex transactions. It is also important to maintain accurate documentation and timely reporting to avoid penalties, and the use of automated compliance system and forex management tools. Dear students, let us now conclude what all we have discussed in today's lecture. We have discussed and understood that Foreign Exchange Management Act is a cornerstone of India's liberalized foreign exchange regime. We have also appreciated the fact that FEMA ensures macroeconomic stability while promoting cross border trade, investment, and remittances. We have also seen that its shift from control to facilitation reflects India's economic transformation. It is rightly to say that adherence to FEMA provisions is crucial for business success in global markets. And in the end, as global financial integration deepens, Foreign Exchange Management Act's role will remain central to India's external sector growth. Thank you very much, my dear students, for being with me in this lecture.